This is your Monex Metals Market Update with Mike Maroney.
Good afternoon. It's Thursday, January 31st, and I'm coming to you from the Monex Financial Studio. Today we have a very special guest, Bob Wiedemer, the author of America's Bubble Economy, Aftershock, and Aftershock Investor. Bob came by today to talk to the Monex account reps about the conditions that currently exist in the marketplace and some of the catalysts that have a tendency to press and move the price of precious metals. First of all, I'd like to thank Bob for coming and wish Bob a happy birthday. It's his birthday today.
Thanks so much, Bob.
Happy birthday today, Bob. Bob, it was great having you today, and obviously a lot of people are talking about gold, and some people are pretty confused right now. With the onset of QE3, QE 3.5, many people thought that the price of gold should be skyrocketing higher, but it's kind of sold off a little bit. What do you think about that?
Well, gold doesn't always react to current events as we might expect. In 2008, the stock market fell rather dramatically, and gold fell right with it. It's still done pretty well overall, though, and obviously in the last 12 years, we're up over 500%, and even last year, we were up over 6% for the year. So it definitely has its ups and downs. Normally it will follow predicted sort of reactions, meaning if the dollar falls, gold goes up, that kind of reaction, or QE is announced, gold should go up, but not always. I use the analogy, it's just like a CEO of a corporation. Sometimes they do really good things and the market doesn't take notice and the stock maybe goes down or goes sideways. Sometimes they do really bad things and the stock goes up or goes sideways. So markets don't always react perfectly to news that should be positive or negative. And in this case, I think that's what's happening with gold. But the fundamentals are very strong. Remember, we've had two countries announcing money printing, more money printing just in the last couple of weeks in addition to our own, England and Japan. So I like the fundamentals. And I'm not too worried about the fact that every little move doesn't necessarily immediately result in a big jump in gold. Again, still up 6% last year, up 10% the year before. It's not bad.
Now it's interesting because since 2002, gold hit a low of 252, hit a high of well over 1900. So bottom line is it's up 500, 600%. Yet if you look at what the NASDAQ, the S&P, and the Dow has done, it hasn't really performed that well, I mean the stock market in comparison to gold, but everybody always seems to be so excited about stocks. Why is that, Bob?
Well, right now we are in a bull market for stocks. I mean, stock has almost doubled since its lows of 2009. So they're excited and it's continued on. But you're absolutely right. People don't look at a longer term level. Stocks are just getting back to where they were in 2000 or above. And on NASDAQ, you're right, we're nowhere near, down 30, 35%. From where we were in 2000. And those are big stocks, Microsoft, Intel. So this has real meaning to a lot of people who own portfolio of stocks. I think we're naturally a bit of a stock-focused country. I think we're naturally focused on, hey, if stocks are recovering, that maybe means the economy is recovering, so forth. But if you look beneath the hype, you look beneath the talk, the reality is that it hasn't really done that well, and gold has done amazingly well, and it's also done so very consistently, up every year for the last 12 years. That's an amazing run.
Now interesting, because if you look at what we've seen in the price of gold, 252, currently today around 1660, 1670, we've seen a tremendous move. But you've spoken about how we haven't even really moved in to the arena where gold could start to really perform. Could you extrapolate on that a little bit?
Well, I always say this rise has been in a bad environment for gold. Well, what do I mean? We haven't had a lot of inflation. Bond market's been good. Stock market's, well, it hasn't gone anywhere much, but at least it hasn't gone down a lot. And the dollar is, although it's gone down, it's certainly not collapsed by any means. If you have that reversing in the next few years, I mean, the bond market, it can't perform as well as it has in the last 10 years. I think the stock market could be in for some trouble, and certainly you could see more inflation. Well, and if gold can go up over 500% in the earlier environment, how much can it go up now? And I think that's an important point to keep in mind, is that longer term fundamentals I think are very good, even if short term it doesn't seem to be reacting. Even QE, stocks didn't react immediately to QE coming out as well. So we have to keep an eye on that longer term perspective. what's really driving gold, and all those things that are driving gold, I think are only going to get more positive going forward. We're going to move from a bad environment for gold to a good environment. And I think gold will do even better.
So now we have Mark Carney over in England. We have Premier Abe over in Japan. Both are looking to print additional money. We have QE 3.5 here in the United States. So with all of this, what ends up pushing the price of money higher? When do we start to see higher interest rates?
Well, of course, interest rates are manipulated. Right now, interest rates are below inflation, and they're manipulated by what? Printing more money. That's how the Fed keeps rates low, as they print money. The problem is ultimately that does create inflation. Otherwise, we'd have an easy money policy all the time. Why wouldn't you? Because it's always helpful to the economy. If there's no downside, why would you ever have to worry about easy money versus not so easy money? We would always want to print more money. But the reality is you get inflation. And that will push up interest rates. But there's going to be a lag there because, again, by printing money, you can keep interest rates down for a while, but ultimately, inflation gets to a level where it will push interest rates up, just like it did in the 70s. Certainly, we didn't want to see interest rates go up in the 70s, but they did anyway because inflation was going up. But it could be a while. That said, that isn't necessarily a driver for gold. Now, when that happens, that'll be a big plus for gold. But even before then, and again, we're certainly before then, interest rates have just been coming down over the last few years, yet gold's been going up. So I want to make sure we recognize that short term, that may not necessarily hurt gold that much, but long term, when those interest rates go up, when those inflation rises, we're going to see gold will actually do very, very well because that interest rate will be very harmful to the bond market, real estate market, stock markets. There's going to be some fear out of that. Going to be a lot of movement into gold.
Now, both political parties have spoken over the last few years and said what's happening here in the United States, we're printing money, we have low inflation, it seems to work. Now, you talked a little bit about the Wiedemer plan today, and immediately I think you got most of the votes of the account reps. Can you explain a little bit more about that?
All right. Well, it's always often said that, well, if we are printing so much money, it's not creating inflation, then I guess there's no problem there, right? Well, if that's really true, then I propose the Wiedemer stimulus package. You really want to get this economy turned around? You really want to get a lot of homes built? You really want to get a lot of things moving? Let's just get rid of taxes. I'm going to please both Republicans and Democrats. I'm going to get rid of corporate taxes, income taxes, Social Security taxes, get rid of them all. Let's kick off a $500 billion set of infrastructure improvements. I'm sure there's things we can buy, the government can purchase. Let's just run up that budget to $4 trillion, and then we just borrow it all, and we have the Fed buy those bonds. Right? If it doesn't create inflation, why don't we just do it that way? You'd get a massive boost to the economy. Everybody would agree. And the Fed just buys the bonds, and if it never creates inflation, what do we have to worry about? Well, of course, everybody knows it probably isn't going to happen. It can't happen. It will create inflation. And what we're doing now will create inflation. I'm just taking it to its obvious sort of extreme, and it's not that extreme. We're already, basically funding a third of our budget with printed money. That QE 3.5 you mentioned, that's now $85 billion a month. That's about $1 trillion a year we're printing, and that's about how much we're borrowing. So we all know that in some way we're not going to get away with it. What we're all hoping is we'll get away with it for a while. But I'm saying, yeah, maybe a while, but not that long. And when it shifts, it could shift very quickly.
Now, we're printing approximately $85 billion per month, and obviously the Federal Reserve is buying bonds, but recently we've seen the price of the longer end of the curve, or at least the price of the bonds in the longer end of the curve come down, which means they're paying a higher yield. Is that a sign that maybe people are starting to realize that inflation is inevitable?
Maybe, but I think we're still a tad early, although you're seeing some sign of inflation expectations in things like TIPS, inflation-protected bonds. You're seeing a little bit, as you see in the long bond, but that's also partly this rotation. People are taking money out of bonds and putting into stocks. But I think ultimately you're going to see this is the kind of thing that I think will cause, that will eventually indicate that we've got a real problem. But I think we're still kind of in the early stages of that to say we've made a big change. It's coming, and that's exactly the kind of thing to look at, but we're not quite there yet, I don't think.
Now, it's interesting because yesterday they released the GDP numbers, and the GDP numbers were negative.
Yeah.
But sure enough, the stock market was retesting all-time highs. So investors are a little bit confused. The price of gold, a safe haven investment in an environment where we're spending more money than we take in, 40 cents on every dollar is borrowed. Our deficit is $16+ trillion, yet the stock market goes up and gold stays somewhat stagnant. could you see an inevitable sell-off in the stock market and rotation out of that arena into gold?
Well, absolutely. A little more complex, but you're on the right track. And what I was saying is that people's psychology can overcome bad news for a while. Great example. When Steve Jobs died, the creative genius behind Apple, the stock over a period of time almost doubled. Well, that doesn't really make sense, does it? I mean, this is the creative genius behind Apple. It really, maybe, I don't know how much it should go down, but the chances of it going up, no, it doesn't really make sense because he's really the driving force. Same thing today. Well, we have GDP going down. That's negative. That was a pretty big surprise. We've had other indicators of a slow economy, yet people want to overlook it. So when psychology is positive, people can overlook bad news pretty well, but not forever. Apple shows it. We're actually, Apple has crashed back down almost to the levels of where Steve Jobs died. I think the same thing definitely can happen with the stock market. Psychology will change, and it can go down very quickly at that point. So, whenever you see the stock market trending too far away from reality, be careful. And when people get nervous, we could see some downturn in gold, but we found overall the gold market definitely tends to benefit from nervousness about other investments. It will definitely do a lot better. So there will be some rotation out. It doesn't take a lot of rotation to really push gold up, though. It's not the size of the stock market by any means in terms of how much money it has. So it doesn't take much out, and it can go up quite a bit.
Now, interesting, because the euro has actually rallied approximately 11% against the dollar. Right. And has it gotten any better over in Europe?
Well, printed money works there too, right? The ECB, the European Central Bank, has essentially said we're going to back Spanish and Italian bonds if need be with our printed money, and that has helped stabilize the financial markets in Europe. But the European economy, no, it's doing terribly. I mean, all the major European nations also reported down or negative growth in the fourth quarter. Germany, England, France, all down. So no, it isn't any better. And that said, the European Central Bank may even be worried that euro is getting up and may want to push it back down a little bit. But no, certainly the situation isn't better, but the financial markets have been stabilized, like ours, by that printed money. But the economy, in a sense like ours, is doing very poorly.
Now, in the past, when the Japanese printed money, the proverbial yen carry trade was the word of the day. Right. And back then, it seemed to be very positive for the commodity markets. A matter of fact, I think they just announced that gold made a new all-time high basis the yen. Right. Do you see the continuation of the yen carry trade inevitably being very positive for commodities, especially precious metals?
Well, I think it will certainly help. I'm not sure it's going to be one of the big drivers behind gold. Japan's got a particular problem they're going to have to fight with printed money is that they have borrowed even more than we have, their government. And that was easy to do because they had a lot of internal savings in Japan. People saved a lot, but now those people are getting older and they're having to cash in their savings to live on. So increasingly the Japanese government's forced to look outside Japan for money. That's going to be interest rates go up, and with their huge debt, that's a huge, huge problem. So they're going to be increasingly between a rock and a hard place. That's why they're printing. I think that it will, ultimately I think that has a positive effect on gold, absolutely, but I'm not sure it's one of the major drivers, but certainly another thing that could have a positive effect because, Japan's between a rock and a hard place. That's why they're printing money now, a lot of it.
Interesting. Now, a lot of people were talking about the event that took place back in September when the Chinese started to actually other countries started to accept the yuan as payment for oil. And a lot of people thought that would be the end of the petrodollar and inevitably the end of our status as the reserve currency of the world. Do you see the dollar losing its reserve status in the next 5 to 10 years, potentially?
Well, let's define reserve status. What we really mean is that how much of dollars are held by central banks versus other currencies. Right now, central banks hold about 60% of their reserves in the dollar and about 30% in euros. The other 10% in a variety of currencies like the pound. So we are a reserve currency. We are the biggest. But when we say the reserve currency, well, it's a little bit more complicated. And could we become less of reserve currency? Meaning, could the dollar become 50% and the euro 40%? Sure, might even get more than that. I think what we're, and it will have some effect on the price of gold. But I'm not one of those ones to say, hey, the dollar's going to die tomorrow. I don't necessarily think everything's going to happen overnight. Well, maybe when it does happen, I think it could happen overnight, but I don't think that's going to happen right now. You have to be a little careful about calling a major in too early, but you also have to be very careful to make sure that you know it will happen long term. Just because it doesn't happen today doesn't mean it won't happen. But I don't think the dollar is going to have a big collapse or people are going to move towards the yuan in the next year or so. But I think ultimately the dollar will fall a lot, and it could do that very, very precipitously. Because essentially we're trying to manipulate our currencies up, and ultimately manipulation of almost all forms fails.
Now it's interesting you use the word manipulation. I know the governments have a tendency to use the word intervention.
Yes.
It's a nicer word. But a market that's manipulated, if a market is suppressed, inevitably it usually goes much higher. And if a market is artificially supported, inevitably it crashes much faster. Do you see that potentially in today's stock market and in the gold market?
Well, we actually call the term market cliff. And this is nothing new in the sense that we've seen when central banks, say, manipulate currency markets. They want to hold the markets up, and they tend to do okay. You know, the currencies, you know, might be stable or rising, and then when the manipulation inevitably fails, you know, the currency crashes quite a bit. Well, we haven't really ever done this sort of manipulation of the bond market and indirect manipulation of stocks like this before, but the same thing will happen. Is ultimately you can only manipulate it at this high level for so long, and then it crashes. So I do see at least certainly indirect, and everybody admits, indirect intervention as the government likes to call it, but it's manipulation of bonds, mortgage markets, obviously indirectly of stocks, and in fact currencies, same thing. We're all manipulating those. Gold sure does seem like there's an invisible hand out there pushing gold down at times, but it's interesting how strong gold has been able to fight back up. Doesn't mean it's gained a lot, but it's been hard to push it down. So you're absolutely right. To the extent that that is manipulation, when it changes, that means gold could pop quite a bit, more than it normally would. And same thing is true for stock and bond markets. They can also drop quite a bit faster than they normally would if market forces were allowed to react without government intervention or manipulation.
No, interesting. Do you think the central banks look at gold as almost the canary in the coal mine? And maybe they look at it and say, if we can keep the price from really skyrocketing in any given 2-week or 1-month period, that would be in our best interest.
Absolutely, and it is in their best interest because you don't want people taking a lot of money out of stocks or bonds and putting in gold. I would understand that from a central bank perspective. It makes sense. They want to discourage that. It's not good for the for what they're trying to do to stabilize the monetary system. The last thing they want is for a lot of money to flow into gold. So certainly they have an interest for a while in trying to offset that. I'm just saying, just like any sort of manipulation, it doesn't work long term. Absolutely, if you do it short term and that's all you have to do, that's different. And that's what they're kind of thinking, is these are short term interventions or manipulation, just like QE1 was supposed to be the end of QE, right? We're only supposed to have one QE, and then we're going to do an exit plan. But it didn't work, and that's what I'm saying. We had QE2, QE3, QE3.5, and it's just open-ended. And that's what I'm concerned about, is in reality, little interventions, I'm not too worried about. But if you have big interventions, you're setting yourself up for a huge fall, or, as you said, oppositely, if you're intervening to push something down, a huge rise, say in something like gold. So it's an interesting period, Mike. Let's just put it that way.
Now, you talked a little bit about the central banks, and you broke down to the reserve percentages. The U.S. dollar, somewhere between 60 to 65%, the euro around 30%, and obviously other currencies. But what we're starting to see right now, more and more central banks are starting to buy gold. And obviously these are the bankers to the world, and they look at gold as a key currency to own. What do you think that tells the general investor out there?
Well, this is one of those many little signals that I think you have to look at. It's a signal of psychology. There's no real psychology meter out there. I mean, you can look at all sorts of things from volatility indexes to all sorts of things, but there's just not a great psychology index when people change. As I often say, why did they change in March of 2000 on the internet bubble? You know, psychology can change without knowing, and without having an obvious indicator. So you have to look at a range, and I think that's a very good one. Notice central banks, which actually used to buy about 500 tons of gold, sell about 500 tons of gold, are now buying about 500 tons of gold a year. And I think it is an indication of a general concern, not just in the U.S., but around the world. Keep in mind, gold is, as I always say, very much a worldwide market. that there is some concern and fear out there, the financial system. Maybe not huge, but it's one of those indicators that things are changing. And I think it is a big change, especially important as an indicator, and it certainly does also affect the gold market.
So here we have the world's central bankers starting to diversify back into gold after selling gold for many, many years. We're seeing all of the world's central banks print more and more money. We have QE 3.5, we have $16.5 trillion worth of debt, and we've had a nice little correction in the price of gold. Gold's trading $300 off the all-time highs, silver $20 off the all-time highs. Doesn't it make sense right now, based on what's happening, when the market's in a little bit of a lull, now might be a great time to start accumulating some precious metals?
Well, the time to buy anything is usually when it's out of favor. I mean, I'd even say right now, Apple might be a good buy. It's out of favor. I'm not sure it's a great long term, but certainly, buy things when they're out of favor. Absolutely the way to go. And certainly gold is not highly in favor. You're not seeing the kind of increase you've seen in the past. It could be a very good time. Again, it's hard to do. It's uncomfortable, but that's what good investors always should do, is try to buy something when it's out of favor, and they're obviously going to do a whole lot better than riding the herd, as we saw with Apple and buying at $500 or $600 a share, only to see it drop back down. You want to buy it when it's out of favor, like right now.
Now it's interesting because everybody talks about kicking the proverbial can down the road.
Right.
And a lot of people are saying that road is coming to an end, an abrupt end. And that's the one thing that none of us really know.
Right.
When will that happen? When will we wake up and the U.S. credit rating will be AAA, AA? What do you think will happen on that specific event? And is the road getting shorter and shorter? And is it something that we better start getting more concerned about on a daily basis instead of sitting and thinking it's not going to happen in our lifetime?
Well, two things. I think the road is getting shorter and shorter. And every time you kick the can down the road, this isn't fun. I used to kick cans down the road for fun as a kid.
I remember
that. Yeah. This isn't fun in the sense that every time you kick it down, you're making the problem worse. So that when it does blow up, it has even more devastating consequences, unfortunately. So every time you borrow another trillion, you print another trillion, it just makes it harder and harder down the road. So when things do go bad, they could go bad for a longer period of time. One reason to buy gold. And as you said, it's not easy to predict exactly when all of this happens. I don't have, they don't ring a bell when this whole thing happens. So I think you have to be prepared. And just because something doesn't happen tomorrow doesn't mean the road isn't getting shorter and shorter. I mean, in January of 2000, we didn't know we had 2 months left, only 2 months left in what has been a wonderful 5-year run on internet stocks. So it's hard to time perfectly. I tend to say, buy into gold over time, accumulate. Don't try to time it exactly right. It's hard to do. Some people can, but bottom line is I think you're in a period where the road is getting shorter, and you have to be increasingly careful at this point.
It's interesting because I've heard the analogy where trading in today's market is kind of like being on the Titanic. And gold is like having a lifeboat because it protects you against many of the uncertainties that exist out there. Doesn't it make sense that every investor look at the gold market and say, I need to have at least a portion of my portfolio in precious metals?
Well, I never recommend putting 100% in anything, so absolutely a portion makes sense. Number two, just remember, I think you're absolutely right, it is insurance, but it also has been a great, performing investment and a safe investment. If you define safe as up every year, for the last 12 years, it's already been that way. So it's got a nice track record, and even better, it provides insurance for what may come. Worth putting a portion of your portfolio in? Absolutely. Again, great performing in the past, a lot of reasons it could do well in the future, and it's definitely a lifeboat of sorts, as you say, and I think will work out very well.
Interesting. Here at Monex, we're big believers in gold, but we think this year may be a great year for silver. What's your views on silver?
Well, silver's been trading, I think, very nicely lately, and I mean that on a short-term basis, last couple months. I like the way it's traded. This could be the year of a breakout. We'll have to see. But I like silver now. It seems to have a lot going for it, and of course I like it long term. But just from even a short term, more trader's perspective, I think it's potentially in a really nice position right now.
I see. What do you think about the Chinese economy right now? Do you see a hard landing over there or some problems developing that could cause some serious volatility in the world economy?
I see a very hard landing. Maybe not right away, because remember, they can do kind of what we're doing. They're intervening into their economy and their markets. The government is extremely involved in trying to pump that economy up, and they've just, of course, got a new government that came in January, and so there's an incentive to want to make them look good. You know, just like if you were a president and you would come in prior to your being actually inaugurated as president, what would you want to do? You'd want to try to pump the economy up so that when you got inaugurated, things are looking good. Kind of looks like everybody's cheering the new government, and I think China wants to do that as well. But again, like all massive government interventions, like any kind of manipulations, which I think China is doing, it will pop. So I think that will have a very hard landing. Maybe not right now, but that's one of those sort of big question marks. It could happen relatively suddenly, because it sure is funny that everybody that trades with China is barely growing or negative growth, but China's running 8%. Doesn't seem to make a lot of sense to me. So that thing could change, and again, I think longer term, it's going to be a very hard landing, leading to a lot of volatility. And that also means a lot of Chinese will probably likely be moving into gold as well at some point, and they're already a huge buyer.
Yeah, it's interesting because China has been kind of on the back burner in many people's eyes, but it seems as if the population of China is really starting to get excited about precious metals, along with India. And we're talking about billions and billions of people. So here in the States, we have a tendency to be a bit egotistic. But if the Asian markets really start to get excited about gold and silver, what could happen to the price?
Well, that's exactly right. A great rotation could occur there is people no longer see real estate as the safe haven. They see gold as that safe haven. And it could move in very, very dramatically. You've already seen, as you said, big increases in Chinese consumption. I think longer term, it certainly will continue, and I think it's just one of the great reasons that gold is worth looking at because of that worldwide market. India could be a little more troublesome for a while, I'll be honest. Not sure how India is going to go, but I think China will take up any slack left by India. I think India will remain a huge consumer, but China is a real question mark in gold's growth, I think very much to the upside. I think it's likely it's only one way that's going to go is China's going to ultimately get much more interested in gold than it is today. Continuing a trend. And again, they also have higher inflation than I think they're saying. The people feel it. And I think there's a lot more instability in that economy than anybody admits right now.
So here we have the world's largest central banks printing more and more money, diluting the value of paper money. The price of gold has obviously been very stable, 12 consecutive years in a row that it's had positive returns, and we haven't even seen the real drivers kick into gear as far as price is concerned. So I know a lot of people probably ask you this, but where could you see the price of gold and silver sometime in the next 5 to 10 years?
Well, as you've read the book. I'm not going to answer that directly, Mike. You always want to get that out of me. But I'll answer with, what makes a lot of sense. If gold could go up 500% in a negative period, how much could it go up in a positive period? Well, more than that.
Well, I can do the math.
There you go.
Bob, it's been great having you come in today. Fabulous time. Always an incredible gift of information you share with us. And I want to wish you a happy birthday.
Thanks so much, Mike. Great being here.
Thank you. Well, one of the things we do here at Monex is we continuously strive to bring you cutting-edge information. So please, if you're interested in receiving some of our special reports, or if you'd like a copy of Bob's new book, Aftershock Investor, please give us a call. Thank you.